Hi, everyone. I'm Rick Bensignor. Today is Tuesday, January 25th, and welcome to this week's In the Know Trader Show. Today's agenda, in our trader education portion, we're going to talk about why Boy Scouts would be good traders. In our market overview of the kind of the macro part, we'll take a look at the Dow Jones Industrial Average, the Russell 2000 IWM Tracking Index, and the US 10-year Treasury bond yield chart. And in sector analysis, we're going to take a look at Cathy Woods ARKK fund, ARKK, and go through the top 10 holdings of it, as the ARKK fund is a very heavily owned fund. Obviously, it's been sold down dramatically in the last 2 months and very sharply recently. But I think we're getting closer to a place that it may find an actual trading bottom. And as such, let's take a look at some of the top holdings there and see what we can discern within the charts. If you're interested in the type of work I do and getting reports that I put out, the weekly ETF Tactical Trader Report is our weekly report that gives a very broad overview of the macro market. We'll look very specifically into the US 10-year for key levels, credit spreads, what they're saying and how they affect the market, the gold market, the US dollar index, and a deep dive into the S&P and the key levels that we're looking at. To sign up for that, go to intheknowtrader.com and click on the sign up tab. We also have a monthly report that's called the 7-Eleven report. The goal of that is to outperform the SPDRs, the SPY, on a medium and long-term basis by being involved in no more than 7 of the 11 macro SPDR ETFs, like the XLI, XLK, XLB, XLV, etc. So we don't want to have exposure in more than 7 of the 11. We won't have less than 5, and the goal there is to be able to outperform by avoiding the underperformers over time. We use a combination of technicals and quantitative models to together come up with our conclusions upon which sectors we want to be in and how much we want to weight in those sectors. So that is the 7-Eleven report. And again, you can sign up for that at intheknowtrader.com. Okay, let's actually, while we're here, let's just take a look at what the market's done this year in those 11 sectors. On the far left-hand side is the through last night's close, the return of the S&P, which is down 7.4%. You can see that consumer discretionary and technology are large underperformers relative to the S&P by some 3 to 3.5% worse than the S&P. Healthcare and materials and in fact, communication services pretty close to the S&P. And the standout obviously is energy, up over 13% and a down 7% market. So you have over 2,000 basis points of outperformance in the energy sector. That is and has been our heaviest overweight. We are actually overweighted double its benchmark exposure. So that is definitely helping us, although you still have to put it into context that energy is still only 3% of the S&P compared to something like technology, which is about 28% or so. So it's still relative, but nonetheless, that energy has been our best overweight. So that's what's going on there. Let's talk a little bit about Boy Scouts and why they would be good traders. Now, I was a Boy Scout when I was young. I don't know how big the movement is these days. I rarely find, at least in the metropolitan New York area that I live in, kids who are involved in scouting now. They seem to be much more involved in sports. Not that we weren't, because I played Little League and what else? Well, officially, I guess Little League was the only organized sport I did, because when I was a kid, again, that was kind of the only thing available. Now there's soccer leagues and ice hockey and other things that really weren't prevalent when I was a kid. But I will say, at least where I live, I don't see many kids involved in the scouting movement. And it's a shame, because I had some of my best memories as a kid was being a scout. And my favorite part of scouting was going camping. And we used to go on hikes and overnight trips multiple times a year with my Boy Scout troop. It's what you're taught as a Boy Scout. In fact, if I'm not mistaken, I'm trying to remember back now, some 50 years ago, but the motto for the Boy Scouts of America was "Be prepared." And it's always been kind of a good motto and way of thinking about life, because whatever situation that you find yourself in, whether you're driving a car, going to work and being involved at work, in your personal life, there are so many situations that occur. And certainly in the world of trading, being prepared often gives you a far better chance of success in virtually everything you do in life than not being prepared. And of course, there are times that certain events come along and you can't have particularly prepared for, because they come out of left field and it's not likely they were going to happen. But when it comes to, and here we'll talk about markets and why Boy Scouts would be good traders, is because Boy Scouts as kind of a come from are people who are prepared. They're always thinking ahead, and whether it's the preparation you need to do before going away for a weekend out into the woods where you have very little access to things that make life easier. So you've got to pack up both food and shelter and things to do, even if it's supposed to be 70 degrees and sunny, you could get stuck in a rainstorm. Always good to prepare yourself for the unexpected things, as well as what you know that you will need to deal with. When it comes to markets, being prepared for the events that, let's say, have even occurred in the last week could have saved you, and would likely have saved you, a significant amount of money. So, you know, we've been giving our clients, in the No Trader clients, the very key levels that we've focused on in the S&P for months, and those numbers have moved up slowly over time. And what those numbers were essentially our stop out for having full long exposure that we had. And when we broke under just approximately somewhere in the low 4,500s, my recommendation for weeks on end had been, you want to lighten up longer term exposure to the market if that level broke. And it broke on last Friday's close. I think it actually were probably beneath it last Thursday, even, if I remember. And Friday ended up just pushing more weight down beneath that number. But that was our clue that the game had changed. And it was the first time since the March 2020 bottom had been in place that we had said that there is truly a material difference going forward than what had been. And the preparation that one could have done in anticipation of that Friday close beneath our key level saved you a couple of hundred S&P points already in the week going forward. So it really does pay to think about the whole concept of being prepared. Certainly when you put in, let's say you buy a stock and you put in a sell stop, that sell stop is your protection, and it is your way of being prepared that the trade idea you had put on is not doing what you thought it was going to do, and it's your way of minimizing risk. And everybody knows who plays the markets, the most essential characteristic that any individual can have in successfully managing markets is, the best way to say this is controlling risk, is managing your downside. And that is, if you, all successful traders know that managing risk and having discipline is the most essential success over time. So Boy Scouts would make good traders because they're prepared. And here, let me show you even, it's not only knowing when the game is going to change on what was a bull market into perhaps no longer a bull market. And it doesn't mean the longer term picture isn't obviously long term, you're still in a bull market, but the near term picture has changed for the first time. And what I've said to clients is, at least now you know we've got a two-way market coming ahead, meaning the buy on dip mentality that we have, I guess, consistently had is now changed into looking at markets from a two-way perspective, because the likelihood that this market just turns around and screams to new all-time highs is not high, given some of the damage that has occurred in the last week. So with the S&P, I don't know, right now it's about, it's a little north of 4,300, off of a 4,800 high. You know, we've fallen 500 points, and 500 points off of 4,800 obviously is nothing compared to 500 points if you had only been talking about a 2,000 point S&P at its high. So in percentage terms, 500 points means very a different amount now than it used to mean, because it's coming from a much higher level. But nonetheless, the market has finally gotten kind of its correction, and the question is that all that's going to happen? Was this a 1 week sell-off and that's it? And now all of a sudden the market's going to change the thought process that just occurred over the last week and just rebuild from here, or is there more room to go? And there, again, in our reports, we define, and this week there is a material change. One of the components besides the S&P itself that has me thinking that things may last longer. This corrective phase may last longer. And of course, our readers will understand why and get into what we're looking at and how and why this could be. But it's so much of this is about preparation. So here, I want to bring up a chart. This is Rivian. This is the new automaker that supposedly might be the only one to really be able to compete against Tesla. And you see that it IPO'd in November. It shot up from 90 to, it doubled itself up to 180, and it's been steadily coming down. One of the ways I can look for how to find the bottom on something that's that's trading on all-time lows, which this has been doing consistently for the last month, is a methodology that Tom DeMark had created, and it's called an absolute retracement level. And it's a way of measuring off of how the high was made, where you may get, it's actually kind of doing a Fibonacci, using Fibonacci numbers off of absolute levels instead of versus some prior low. And when I did it off of the way this happens to be calculated, it gave me a level of significance at 55.80, essentially 38% of the closing price of the day that made the all-time high, if that day's close was called a stable close, which means the next day overlapped the close so that there was no gap. There was a gap here, so often we'll take the next day's close. And that's what I've actually measured from here. So this level of 55.80 is 0.382 of this closing price of 146.07 on the day after the all-time high was made. And unrelatedly, so that calculation happened to be 55.80. Unrelated to that, a propulsion full exhaustion level of the break that occurred at 94.32 measured to, let's see if they're so close to each other that they're both showing up. Here we go, 55.99. So 19 cents away, meaningless difference, right? So just under 56 is a level. So for a month now, I've had a resting order right around this level here. The fact that I had two unrelated downside targets come to the same place had me put a bid in just about, just around the $56 level. So yesterday, I basically bought right near the low and could have made as much as virtually $7 on the bounce just quickly. Now, obviously, with the market down large again today, this is pulling back, but I have a very clearly defined risk level now. And I know that if I get anything, beneath a few bucks from under here, then this level is not going to be the one that holds. In fact, what I could do, and this is, I could actually wait to take this measurement from the first stable close. So the all-time highs close is not stable because the next day's range did not overlap the close. Even the day after that, the next day's range did not overlap this low. Here, the close, sorry. This day here, which is, let's say, November 19th, didn't actually get as low as the close of the day before, so another gap. So finally in here, we see that on November 22nd, this day's close has the next day's range intersect the close. Finally, we have a stable close. I could, in theory, take this close. So that goes down to 45.12. So if I wanted to pick a different downside target, in theory, I could take that as a place to stab a bottom. And if I'm looking to get into a name that I think over time could perform, and it's obviously getting hit now because the whole market is, these are places that I can look for bottoms to come while stabbing for a low. But this all falls into being prepared. I know the levels I want to be trading at. Today, let me just show you the spiders. So here's spiders in real time. Right now it's trading at 429.75 or so. So what I did, this here is market profile. It's essentially volume at price. So lots of charting systems have this. And what I did is I looked at where the bottom of yesterday's value range was. And it was just around 428. And I looked at where the highest volume done yesterday was as far as tick volume, the amount of times back and forth this level traded. And it told me it was somewhere in the upper 427s. So now I've got both the bottom of the value area and the heavily traded area at 427, the high 427s. I put it into order today. I bought spiders. You can see the low of the day is 427.15. I put in an order last night to buy these at 427. I think I picked 75 or so. I just picked a level. And so I bought some today, and since I bought them, they went as high as about 432. And I'm not going to stick around long with this because to me, either this level is going to hold or I don't want to be long the spiders again. Because I think they're going to go and potentially test or even exceed yesterday's low. So I have a very defined level here that I'm leaning on, and it's, again, being prepared. I did my work. I knew that if, even despite yesterday's close in the S&P at as high as it got, we gapped significantly lower today, but I bought right into the level that I wanted to buy at. And it just, in looking back, I see it happened to be right around the October lows too, but I was buying this purely based upon yesterday's price distribution and looking into where I saw kind of high volume and the bottom of the value area, which represents the first standard deviation of price activity from yesterday. So it's, again, it's about being prepared. So that's why Boy Scouts make good traders, because they're prepared. All right, let's take a look at what's going on in the markets around. So we'll start with Dow Jones. Here's a weekly chart. I've highlighted this yellow box for several weeks now as being where the support would be, anywhere from this green trend line, which got broken, that comes off of the gap up in November of 2020. So that broke yesterday, but that was just one of multiple things that we saw on this level. It's the top of the weekly cloud, it's last June's lows, and it's a TDST level going back to July, which is this horizontal dotted red line. So all in here, we've got support. And we know that if it breaks, I really don't see a heck of a lot to stop the market from going down to all the way potentially to the bottom of the cloud. So in and around yesterday's low really is kind of important to hold, or you potentially open the door for a more significant decline. So that's also why I'm willing to buy some spiders here just to get a bounce. These are not long-term hold spiders probably, but more something that, you know, I could potentially make money on fairly quickly if we get a bounce and kick them out. That's the Dow. Let's take a look at IWM. Here's the weekly chart. So this got very close to the bottom of the cloud. It's bottom of its cloud. Obviously, small caps are much weaker. It spent the entire year last year distributing and just going sideways. We had the false breakout, which got a lot of people, including myself at the time, to buy into this, but it didn't take too long before we realized this false breakout. Well, the breakout would become a false breakout, and you know it is now completely come out the bottom end of the range and getting closer to. You've got support down at 221, the bottom of the cloud, for the next several weeks, as well as a, let's see, is this still active? It is not. So this level is actually not meaningful to me as picking a place, but anywhere, you know, we're getting closer towards the bottom of the range. But think about it, everybody's been a loser for the entire year. So you have to go back to January of, well, I guess January 2021 is the last time somebody bought IWM is making money in it. So you've got a lot of overhead resistance here. That's going to make rallies pretty darn difficult for small caps. So they're not in a good position. And let's just quickly take a look at the 10-year. So in the beginning of 2021, I targeted 186, I think it was, yep, 18.58. So 1.86% as the necessary breakout level for yields to get above to really change the picture. Now, there's clearly an inverted head and shoulders. The green dash line is the neckline that has broken out. But to me, that wasn't good enough. You really need to get above this 186 level on multiple Friday closes to then target 2.25% to 2.5%. Otherwise, it's still kind of iffy here. And do I think it's going to go? I likely do, but I'm not jumping on board this pattern yet until we see the real breakout to me occur. All right, let's take a look at some of Cathy Woods' names in the ARK fund. Tesla, double top. Let's put up. All right, so this did top. The second top really, it's actually almost a triple top spread out over a few months. On a sequential 13, we've fallen beneath the baseline. We did stop at the propulsion full exhaustion level here, and this is where you got the breakout from. So there's some minor support here, but at this point, I'd say you're probably gonna, whether we use Bollinger Bands or, well, in this case, let's see, they're still pointed up. So I'd probably look at something around 1,027 or so as resistance. And I'm not sure this is done going down yet. It's as oversold as it's been since last summer, but not a guarantee for me to be a buyer here. I'd probably still be a seller on a rally if you have it in your portfolio. TDOC. Very different looking chart. Let me pull off what we don't need. So now you've got this. This is a possible name to start thinking about on the long side. Of course, it's broken all cloud support, but you do have some exhaustive signals starting to show up here. Price is down at 71. You'll see this is really kind of where it broke out from, somewhere down in the upper 60s to low 70s in the past. So a place that certainly you could start thinking about looking into this. This has been trashed very badly. Zoom, 13.9. Well, let's see. I actually would be more inclined towards being a buyer than a seller at this point. Clearly you've missed the sell-off. More names coming up with 13s. Roku on a 13, again, broken cloud, but kind of also just above the area that it surged from. Much better towards the buy side. Look for any exhaustive type down move here to come into it. Coin is a name I've spoken about before. I got hurt on this one. I am long well higher, and the only thing I can really lead on now is the setup 9 count. This is, we've made all-time lows this week. And I could nibble a little, but obviously there are going to be a lot of people trapped, including myself. EXAS, Exact Sciences, other than the lows here from back in 2020, which we're at now, really not much to lean on. So maybe a small trading bounce, but it's not exhausted yet. Unity Software, also a weekly 9. Some of the 9s have worked in the past. 2 out of the 3 of them worked, at least for some type of trading bounce. Spotify, not enough to really have me come in, although this is where, look back, this is kind of where it surged from. So anywhere in here down a little to maybe 160-ish is probably a place I'd look to buy. And that's all, unfortunately, that's all the time we have for this week. Thank you for listening to In the Know Trader. I'm Rick Bensignor.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.